Hello, everyone, and welcome back. In this module, we're going to look at the three basic financial statements, and we'll talk about some of the other financial reports that are beyond just the three basics. If we think of the number three as we're going through our financial statement module, it will help a lot because you'll find that we repeat this multiple times. There are three financial statements. Each of the statements have three basic components, and the three is repeated multiple times as you see. When we look at the financial reports that are most important coming out of accounting that an organization, and specifically finance, uses to assess where we are and where we are going, the three most important, the three that you're concerned with, your lenders are concerned with, your investors are concerned with, are the balance sheet, the income statement, and the cash flow statement. Very important for us to remember as we're going through financial statements. Each of the three is a different piece of the puzzle. Each of the three financial statements tells a different story of the company because its purpose and its perspective is different. So let's start with the balance sheet. The balance sheet is the financial statement that basically opens and closes any period of time. The balance sheet is like a bookend. It's a photograph of our company or a snapshot at a point in time. So you look at your organization today. What do you own? What do you owe? What's the difference? There's your three. It is as of a specific date. So you could create a balance sheet every single day. In fact, most banks are required by law to create a balance sheet every single day. And the primary reason is to make sure that their proportion of assets and liability, loans and cash, meet regulatory requirements. If they end up having too much or too little cash, they must do something immediately. So think of a balance sheet as a photograph of the company. We take a picture of our company today, then we have some period of time in which there are transactions, which we'll look at next, and then we have a snapshot or a picture of our company to end that period. So those are your bookends. And again, the three components of the balance sheet are assets, what we own, liabilities or debts, the amount that we owe against those, and the difference is equity or owner's value. That's our balance sheet. You start with the balance sheet, you end with a balance sheet for a period of time. In between the balance sheets, we're going to have two other financial statements that again look at the organization from a different perspective. We have the income statement, also called the profit and loss or the P&L. It has a beginning date and an ending date. It records activity over a period of time. For almost every organization, it's a single year. But frequently organizations create income statements for a given quarter or a month. And technically, we could create it for any period of time. But those are the most common time frames: monthly, quarterly, or annually. What is the income statement designed to do? It records all of our revenues or sales. That's what's coming in. All of our expenses or cost. That's what's going out. And the net result, which is either profit or loss. So here again are your three components. Component one is revenue. Component two is expense. Component three is profit. We always hope it's profit. Sometimes it's not. So a balance sheet starts and ends the period. In between that is our income statement. Well, if our income statement records revenue and expense, why do we need a cash flow statement? If you remember back in Module 1, we talked about the difference between cash accounting and accrual accounting. The income statement records our accrual accounting, revenues when we make the sale, not when we collect the cash. Expenses when we incur the obligation, not when we spend the cash. That's the income statement. The cash flow statement, the third of the three financial statements, also records activity over the same period of time as the income statement, but is looking at cash in and cash out. Sources of cash, what's coming in cash as a result of transactions, and cash out, or uses of cash. Where did the cash go? There are three components of the cash flow statement, and when we dive deeper, you'll see their relative importance. The three components of the cash flow statement are: number one, operations, which is our main business; number two, investing; and number three, financing. So let's back up a moment. If operations is our main business, we're saying, okay, what cash are we using in our operations, our day-to-day business, and what cash are we creating or is coming in? That's straightforward. The investing side, this is where sometimes people misunderstand, misinterpret the word investing. This has nothing to do with buying stocks and bonds. Investing on the cash flow statement specifically refers to our acquiring long-term assets, investing in ourselves, or selling off, divesting long-term assets. So if we acquire a major piece of equipment, a building, that cash expenditure in this period is recorded as cash outflow or use of cash in the investing section. If we sell off an old piece of equipment that we no longer need, that would be recorded, the actual cash coming in the investing section of our cash flow statement. So operations is our day-to-day business, cash in and cash out. Investing is long-term asset acquisition or disposal for our own purposes. So we have operating, we have investing, now financing. The third component is financing. That's where either we're going out and getting new loans, that's a source of cash, or we're paying off the principal of old loans, that's a use of cash. We're paying out cash dividends from our income statement, some of our profit, that's a use of cash, or we may be selling new shares, that's a source of cash. So for the cash flow statement, covering the same period of time as the income statement, the cash flow statement's three components: operations, our main business; investing, long-term capital assets; and financing, which is our debt and equity. Those three components of the cash flow statement, linked with the three components of the income statement: revenue, expense, and profit, linked back to the balance sheet, assets, liabilities, and equity, is how we get a very complete picture of any organization at any time. What was the balance sheet? What did the organization own and use and owe at the beginning of the period? What were all the revenues, expenses, profit, cash in, cash out, and net cash reported on the income statement and cash flow statement? And then what is the ending or closing balance sheet? If you look at these, and we'll look at an example in a little while, we'll get a very complete picture of the organization itself. So let's look at the first of the three financial statements with just a little more detail. Now here's an important point to remember. We're presenting these in the order of balance sheet, income statement, and cash flow statement. There's actually no correct order in which to present them. You can look at them, you can present them, you can talk about them in any order you want. They're all interrelated. So the sequence is not important. So the balance sheet. It is called a balance sheet for a very simple reason. You look at the bottom of the slide, there's a balance sheet equation, also called the accounting equation. Assets equals liabilities plus owner's equity. That doesn't mean maybe or sometimes or approximately. The balance sheet equation is an absolute. It is one of the fundamental keys to making sure that financial statements are accurate and complete. You know, anytime you look at the balance sheet, that the asset side of the balance sheet, frequently on the left side, must exactly equal liabilities and owner's equity. If you ever find a balance sheet where that equation doesn't work, there's a different value on one side of the balance sheet compared to the other, there's a problem with the balance sheet. It's wrong. Not maybe. It's simply incorrect. And this is why we go back to the double entry accounting we talked about at the beginning, the matching principle. If you go through the transactions that created this balance sheet, they must offset each other. So the first little secret, the first key to understanding financial statements is looking at the balance sheet and making sure it balances. Next, remember it's a snapshot or a photograph of the organization. So right at the top, it should say as of and a specific date, or have a date there that's a date, not a period of time. It shows the three components we talked about. Assets, things we own; liabilities, amounts that we owe against the assets; and equity. And we'll really subdivide those into a little more detail at this point. Assets and liabilities are subdivided into current, we're talking about the next year or less, and long term. So let's look at current assets first. Current assets are those assets that we have and will use under normal operations within the next year or less. So that could be cash in the balance sheet that we pay out today, or over the next week, or the next 3 months. We'll look at these in a little more detail on the next slide. So current refers to the next year or less. Long-term assets are those assets like buildings, etc., that by our plan we will use for greater than a year. So you can see that 1 year cutoff makes the difference between current and long term. Same thing with liabilities. Current liabilities are those that by agreement will be paid within the next year, maybe next week, next month, but definitely in less than 12 months. And long-term liabilities, like mortgages, that by contract will be paid over a much longer period of time. The third category in the balance sheet is our equity, also known as ownership value. Most organizations are incorporated. So if there's a corporation, there'll be shares. So we'll look at what was paid for those shares. There's your initial capital. And what are retained earnings? Now we want to be clear on what this term means. Retained earnings on the equity section of the balance sheet refers to all of the previous year's profits that were not paid out in cash dividends. So if the company is 1 year or 100 or 1,000 years old, what were all of the profits of this organization from the beginning of time through this balance sheet added together that were not paid out in cash dividends? So we could look at the income statement for the last 2, 5, 25 years. Add up all the net income, take away all the cash dividends, if any were paid, and that would equate to the retained earnings. So over time, if a company is profitable, you can see the retained earnings must grow, which means the value of the organization must grow if we go back to the balance sheet equation. So let's dive down and look at this just in a little more detail.